Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is June 24th, 2010, and my guest today is Arnold Kling, who blogs at EconLog, part of the Library of Economics and Liberty. Arnold, welcome back to EconTalk.
Thank you.
Our topic today is an imaginative one. I want us to imagine a little bit about the world without government, particularly in the financial and credit and mortgage markets, and try to think about what the world might look like if government's role was different from what it is now. There is a tendency, as you've noted many times at EconLog, it's a tendency to try to recreate things that went bad during the crisis. And we might instead say, well, maybe we ought to move away from that instead of trying to recreate what we had before, but better, of course. So I thought what we'd do today is, and the idea for this conversation comes from a post that you did imagining what a world would look like without government involvement in the mortgage market. I want to start the conversation by asking you about what banks do or what they might do in a world that was less government regulated. What is the role of banks in connecting people with money and people who don't have money?
Well, that's certainly a question that has produced plenty of arguments, but my view on that is that people who are not in the financial sector, that is, people who are entrepreneurs who are looking to fund investments or households that are trying to save, would love to have on their balance sheets risk-free liquid assets, things that look like checking accounts. And at the same time, they would like to have on the liability side of their balance sheet risky liabilities. So consumer debt that has no collateral behind it, or long-term investments that are illiquid. My favorite is planting fruit trees that aren't going to produce fruit for quite a while. So you have what I call the non-financial sector wanting to have riskless liquid assets and issue risky illiquid liabilities. And what I see the financial sector is doing is taking the opposite side of that. So they hold the risky illiquid assets like the shares in the fruit trees, and they issue riskless liquid liabilities like checking accounts.
But what a bank is just somebody, in theory, is an economic agent that connects people on those sides of transactions. I mean, the bank really isn't on the opposite side of the transaction. They are literally, but they're really bringing together other folks on the other side. So the way I think about it, and it's different from the way you think about it, so maybe we can try to merge them together. I'm a professor, and in good years where I keep my expenditures down, I spend less than I consume. So I have what we call savings, and I have to decide what to do with that. So it's good to do a bunch of things with it, diverse things. Some of the money I'm going to put into assets that I don't expect to get at for a while, those fruit trees you're talking about that might have we hope, a higher rate of return. But I want to keep a lot of my money safe for an emergency or a sudden unexpected purchase. So I don't want to also keep my money in my mattress because it might get stolen if my house got broken into. So a bank, for starters, is a safe place, but I'd like, when I come back to get my money, which I'm going to do in an erratic way, I'm not going to say to the bank every 6 weeks I want to take a certain amount out. I want to say, here's a bunch of my money. Take good care of it. Don't let it get stolen. Put it in a big vault with a really thick door and people with guns to protect it, which I don't want to deal with in my house. And in the meanwhile, you might want to do something with it that would make interest, that would earn money, additional funds, so that when I come to get my money back in 6 months or a year or 3 years or 5 years, and I'm not going to tell you when I'm coming, I'd like to get more than when I started. And so I'm willing to let you, the bank, do something with my money that's as long as you're able to pay me back when I come in at this unexpected time in the future. So the bank then is going to look for opportunities to lend that money at rates that are higher than the rates they promised me so that they can cover their costs. And some of the things they're going to do are going to involve housing. Some are going to involve backing small businesses like you talked about that want money up front because they're starting a business. How does my story, how do we connect those two stories?
Well, let's do it this way. One question to ask is, what can a bank do that you can't do for yourself?
That's good. I like that.
One thing it can do is it can, as you said, it could have some, I think of this sort of economies of scale. Maybe, it has vaults, and, it's expensive for you to put a vault in your house, but if you spread the cost of a vault over lots of people, that's one story. It's not my key story.
No, but that's true. That's good. So what? But the second thing is
one of the things that a bank can do is diversify. So it's hard for me to buy small shares in lots and lots of risky investments, lots of different entrepreneurs' businesses. But a bank with its economies of scale can do that, and because it has a diversified portfolio, gets a better risk-return trade-off. So that's one story.
And there's a piece of that that's, I think of as even more important, which is I don't want to really become an expert at figuring out who's reliable and who's likely to pay me back. And
right.
So the bank's doing that for me.
That's the second story. So first there's diversification, and there's also they diversify across consumer needs. So you may need to take out money tomorrow. I may need to take out money next week. By having a diversified set of consumers, they don't need to have all their money withdrawn at once, even though each of us individually might be making big withdrawals at different times. So it takes advantage of that kind of diversification. So there's diversification at the lending end, there's a diversification at the deposit end, and there's the other issue which you raised, which is it develops expertise in assessing credit quality and in managing loans, and deciding when to squeeze the borrower, when to give them an extension, when to foreclose, whatever. So in underwriting, that is selecting risk, and in servicing, managing a loan portfolio, the bank develops specialized expertise. So those are the things that the bank can do that you can't do for yourself. It can diversify more effectively, and it can develop specialized expertise. And the third thing that happens with banks is what's important, in addition to their ability to do that, is they have to have a reputation for doing that. Because if you don't believe that the bank is actually good at doing what it does, you won't trust it with your money. And if you do believe it, then you will. And that third aspect, so there's sort of three ways that banks kind of induce you to bring money, put money in them. One is they diversify well, better than you can. The other is that they have specialized knowledge. And the third way is the reputation. And it's the reputation that I think creates the volatility in finance, because reputations can just rise and fall. And when reputations rise inappropriately, banks can take more and more risk, and I think that's kind of what happened. And,
it's a strange thing, of course. I don't want to spend too much time on this issue of of reputation, although certainly trust and the potential for bank run is something we're going to have to talk about eventually. But I just want to stick with this trust issue for a minute and reputation. Just the idea of reputation. You talk about how it can rise and fall. It doesn't rise and fall very much elsewhere in the economy. I mean, it can, but it's, when I say Honda makes a reliable car, that's a reputation that Honda has earned over the years. They have worked hard to maintain the reputation. They have an enormous stake in maintaining the reputation. Things can happen unexpectedly. The Toyota brake problem, we'll see how much that's hurt their reputation somewhat, but doesn't seem to have been decisive for the right reasons. It doesn't seem to indicate some across-the-board carelessness on their part. It looks more like either bad luck or the way they handled it was poor. But in the corporate world generally, companies develop a reputation, and as long as they have a large stake in maintaining it, they're pretty good at maintaining it. Walmart has a reputation for low-cost, low-price items of reliable quality. Grocery store chains have a certain reputation of what their produce is like and their cleanliness of their stores, and those seem to be sustained. Land's End has a reputation as a again, they don't make their own clothes, but we rely on them, those of us who shop there, that they will source those clothes from reliable places where the buttons don't pop off all the time, and if they do, they replace them. So it's interesting that banks, of course, their product is a little bit peculiar.
I think that's got to be the story, that there's some more inherent fragility because let's say if an auto manufacturer's product is starting to deteriorate, unless they build a car that, is going to work fine for 5 years and then collapse altogether, your chances are you're going to observe the deterioration in quality. People are going to start to report, I bought Hondas thinking that, the last time I bought a Honda, I got 200,000 miles on it. This time I have it in the shop, 6 times in the first 2 years. And people start hearing those stories, and so the reputation goes away. In the case of banking, the reputation stays good until it's sort of too late for people to do anything about it. I think that's kind of the fragility.
Well, some of that is part of the very nature of how banks make their money, which is they don't have all the money in the bank at the same time, and we don't want them to, right? As the depositors, we want to earn interest on the money. We're willing to take some risk that not so much that all the loans that the bank made will go bad and the money will disappear. That is one way you destroy your reputation. And I think that's, we'll talk about that. But the other thing that worries you, which is sort of abstract and then starts to eat at you if you're worried, is what if all the other depositors show up at the same time? What's called a run on the bank. And historically, that happens from time to time in the banking world and in different markets. Banks usually stem that tide by either in the past, before the government was involved, they would create a consortium to create the resources to solve that problem. And they also, and this is what I'd like to talk more about, they'd also limit your ability to have your money on demand. So I would have to forego, if I want to get some interest, if I want to get more than I put in, I want the bank to be my intermediary and middleman and search for those reliable loans and that diverse portfolio and vet the people, et cetera. I know they have to use my money and your money, the other depositor's money. So I'm willing to forego my immediate access to that money. I might have to announce when I want my money that I'm willing to accept a delay. I'm willing to forego having my access to my cash on demand in return for the fact that they'll be able to invest it more effectively. So it seems,
and there are all sorts of contracts that do that. I mean, the most classic being the certificate of deposit, which
is what?
The certificate of deposit.
Yeah, exactly.
So you can withdraw your CD early. You just don't get as much interest, and you may pay a penalty.
And that discourages me, right, which gives the bank a little more freedom to use the money productively. So what I want to distinguish between, and maybe it's not a relevant, it's a distinction without a difference, but it seems to me there's a difference between a bank that, just for example, this morning I was riding into work and I heard an ad on the radio, which for a bank I will not name. It's a bank that's been involved in the financial crisis. It's offering a very high rate of return on their credit card, cash back 5%. And I thought, wow, that's a lot of money, cash back, 5%. Then I started to think, yeah, whose money are they playing with? Well, they're kind of playing with maybe my money, the taxpayer money. And there's a lot of incentive when banks don't have to bear the downside risks, or when people think that they might be insulated from the downside risks. There's incentives for them to offer rates of return that they normally wouldn't think of offering. So we could think about different ways that banks could degrade their reputation. One would be not degrade; they would lose their reputation. One would be malfeasance. Lending to people who are bad risks, pushing the envelope, holding an inadequate amount of capital to stem a sudden unexpected rush by depositors. Or we could just imagine a madness of crowds, right?
Well, except I think there really are many mechanisms by which banks can overcome a madness of crowds. I think there's a distinction lurking in the background, the classic distinction between being insolvent and being illiquid.
Exactly. I was just thinking the same thing. So explain that.
So if a bank is insolvent, it means that even if you gave it all the time for all its assets to mature, it would still end up having negative net worth.
Couldn't keep its promises.
Right. If it's illiquid, it means that, well, maybe if you forced it to sell all its assets on a moment's notice to meet a bank run, it would have negative net worth. If it could keep going, it would have positive net worth. That would be illiquid. And it can be very hard to tell the difference because a lot of times it's very hard to actually value the bank's assets, and there's all sorts of controversies in the middle of the financial crisis about whether banks were illiquid or insolvent, and there are still people who disagree. There are people who will adamantly proclaim that Citicorp was insolvent in 2008, and there are about people who are equally adamant in claiming that no, it was just illiquid. So anyway, but if a bank is sort of demonstrably solvent, it is very hard for it to actually have a liquidity crisis, in my opinion, because it can go out and borrow money from investors. It can say, "Look, here's my balance sheet.
If they can
here are all these assets.
Yeah.
I can. They can go. In our economy, they can go to the Fed to the discount window. They can go to the interbank lending market, and so on. And the way a lot of people describe the financial crisis is that the interbank lending market broke down because people just didn't trust the value of mortgage-related assets, and so all of a sudden, banks that everybody lost liquidity, and then there was just this question of who's solvent and who's not.
Yeah, the funny thing about that, of course, is that the way it was phrased was banks were afraid to lend to each other. And you say, well, why were they afraid? Well, their balance sheet had these complex instruments. As you say, they were hard to value. We weren't sure what the market value was. But, of course, the flip side, the alternative view was, well, actually, they are complex, but we were pretty sure what the value was, and it was a lot less than they were listed on the books. And that's where the illiquidity versus insolvency issue again comes up. I think it's hard to tell, although now as time passes, I think it increasingly becomes clear that there was a lot more insolvency than people claimed at the time.
Well, it's interesting. I mean, there's certainly, if you compared people's views of Freddie Mac and Fannie Mae to what they were 2 years ago, I think the meter has shifted much more toward insolvency.
Yes.
In the case of Freddie Mac and Fannie Mae, the meter may actually be shifting a little bit more toward illiquidity in the case of Citigroup and Bank of America. Although, I think if you made me choose, I would still be in the insolvency camp. But there's a lot of, the fact that some of these banks have been able to repay their TARP loans and so on, is indicative that perhaps they they truly were solvent. It really was just a matter of keeping them going a little longer. Again,
I think it's too early.
You don't really have the controlled experiment because the Fed gave away profits to banks in big ways by paying interest on reserves and keeping short-term interest rates low and buying up these assets to raise their market value. So
it's a very good point.
So it's kind of a confusing story.
It's a very good point. I think it's too early to tell. A lot of those mortgage-backed securities are still sitting on the balance sheet, and I think I'm told by people who understand it better than I do, they're sitting on the balance sheet at unrealistic levels. And I think Fannie and Freddie are a perfect example. I found an old story from June 2008, which was 3 months before they were taken over by the government. And when they were taken over, as you say, some people said, a lot of people told me, a lot of so-called experts said, oh, they're not insolvent. In fact, they're cash flow positive. They don't even need to be taken over. It's an overreach. It's exaggeration. And in June, this is tragicomic. The Congressional Budget Office.
June of this year?
No, June of 2008. The CBO said that Fannie and Freddie might cost the taxpayers as much as $25 billion, but there was a 50-50 chance it would be zero. According to CBO now, for 2009 and 2010, it's $390 billion, and that number I suspect will continue to rise. So the illiquidity argument seems to have lost out to insolvency in that case of Freddie and Fannie. We'll see what happens with those other banks. But let's turn to mortgages. So when you have a large asset that you want to purchase, typically you'd like to purchase that with some borrowed money, not with all cash, because it's an asset that has market value. It's pretty liquid. It's somewhat liquid. It's nothing like cash, and it's nothing like a Picasso. It's somewhere in between in terms of its future expected value. So I want to go and I want to borrow that money. So let's say I'm going to buy a $250,000 house. We can imagine a world where if the seller of the house would want $250,000, the buyer's got to come up, let's say, with the whole thing. He's not going to borrow any of it. But it would be attractive to be able to borrow it because it's going to be hard to accumulate that much money. Of course, the price might change if I couldn't borrow. But one way to borrow would be to go around to a whole bunch of different people and say, lend me some of the money I need for the down payment, and I'll pay you back at some point in the future. We'd agree to what that time frame would be. The house is very sturdy. You can inspect it. It's in a good neighborhood. That could change, of course. Things change over time, but the asset itself is pretty. It's going to depreciate a little bit over time, but I'm going to take care of it. I'm going to replace the roof and the gutters and all that when I need to, paint it. So I could go around to a whole bunch of people and borrow $10,000 from a bunch of them to accumulate enough to buy the house with some of my own money putting it down. And, of course, that's very costly on my part. And their willingness to lend it to me, they'd be lending perhaps a significant part of their wealth at the time, so they'd want a particularly high rate of interest. And what the bank does is intermediate that transaction. It goes and accumulates the $10,000 from a bunch of people and then lends me the $200,000 so that I can buy the $250,000 house with $50,000 of my own money, say 20% down, and $200,000 from the bank, meaning from a whole bunch of people pooled together for the diversification reasons we talked about. Now, what you speculated about in your post, which was, I thought, very interesting, was first you made the observation that the United States is the only country that has a 30-year mortgage. That is, I stretch out.
That's a little extreme, but it's certainly it's much more common, way more common here than other countries, and there are plenty of other countries where it doesn't exist at all.
So the alternative would be a much shorter mortgage. So why do we have such long mortgages in the United States? What has happened to create that?
The short answer is the Great Depression and custom. Government policy following the Great Depression and custom. Let me back up a little bit. What I what I think is peculiar about our mortgages are what I call the embedded options.
Yeah, talk about that.
So one of the options is the option to turn in the keys and walk away from the mortgage. That is known as technically as a non-recourse loan, meaning that if I default on my mortgage, the bank has no recourse other than to take possession of the house. They can't go after me and my assets. And that I believe the non-recourse loan is a combination of it being state law in many states, although there are some states that allow recourse loans, and then just general custom that's sort of evolved in the direction of the states that have non-recourse loans. But in other countries, for example, Canada, mortgage loans have recourse, so that if the value of your house, let's say you made this, you borrowed $200,000 on this $250,000 house, and now the value of the house has gone down to $190,000
because that's the town got in trouble financially. Some factory left, or my neighbor got some crime in it, or
well, for whatever reason, it's now $190,000. Your mortgage is $200,000. With a non-recourse loan, your best strategy may very well be to walk away from the house, just not pay, even though you might have other assets that would enable you to pay the mortgage. In Canada, that strategy would not be good because the Canadian mortgage is a recourse loan. So after the bank forecloses on the house and loses the money, they come back to you for the deficiency. They say, well, we were only able to collect $190,000 on a $200,000 loan, pay up the other $10,000. And so that sort of changes your incentives a lot. So the bottom line is, in America, with so many non-recourse mortgage loans, the option to default is quite valuable. And the option to default is in some sense most valuable for the loans where you make a low down payment, because when you make a low down payment, that increases the likelihood that the price of the house will fall below the value of the mortgage. So
what we've talked about here many times when we talk about leverage, basically the more leveraged you are, the higher the proportion of the loan that uses other people's money, the smaller a change there can be in the asset price that would put you underwater.
Right. So it increases the value of the default option, which in theory should make the default option expensive for lenders and should cause the interest rate to be higher. So in the United States, the non-recourse nature of the loan makes the default option valuable, and this recent trend toward low down payment mortgages makes that option even more valuable and should raise the interest rate as a result. The other option that's valuable is the prepayment option. That's the option to refinance the loan, typically without any penalty. So if you take out a 6% loan and 6 months later the rates are down to 5.5%, you can get rid of your 6% loan, take out a 5.5% loan.
And then the bank, which was
without penalty.
And then the bank, which was expecting a certain flow of cash from its mortgage, is now not going to is going to see a smaller amount.
Right, but it's a one-way. It's a one-way option. So if rates go up to 7% and the bank regrets its 6% loan, they don't have the option to make you refinance into a 7% loan.
Right.
So it's an option that goes entirely to the borrower. And again, if it were properly priced in, I think that option would impose pretty high interest rates on the types of loans that have become typical in the United States. That is a 30-year loan. The option is valuable because you pay off because you pay off relatively little early in the life of the loan, and any option, the longer it's outstanding, the more valuable it is. Also, the most common adjustable rate mortgage is this weird thing called a teaser arm, where you get a below market interest rate to start with in exchange for what the bank is hoping will be an above market interest rate later on. Although if you take out a teaser rate adjustable rate mortgage, your hope is that in a couple years interest rates will have stayed low enough that you can refinance and not have to pay the above-market adjustment rate. So it's another mortgage where the option is valuable. So what we've evolved in this country are mortgages with extremely valuable options for borrowers. And it's my hypothesis that those options have not been priced properly because of government policies that subsidize those types of mortgages. So my argument is if you sort of pulled the government subsidy rug out of the 30-year low down payment non-recourse mortgage, if you pulled that rug out, the interest rate on that mortgage would be high relative to something like a Canadian 5-year mortgage, where the rate stays constantly for 5 years, and where there's recourse to the borrower. So that if you had a completely free market, people would say, wow, I can get a 5-year Canadian rollover mortgage with a rate of 4%. I have to pay 6.5%, 7% for the American 30-year non-recourse fixed rate with no prepayment penalty mortgage. I think I'd rather pay 4% than 6.5 or 7. And that's how I think the market would greatly reduce, if not eliminate, the 30-year fixed-rate mortgage if it were allowed to work.
So when you say it's your hypothesis, I think it's it's undeniable that that's the case. It's an unseen, wonderful economic insight about how government policy can distort things, and we get used to it, and so that's just what everyone in America just thinks, well, you have a 30-year mortgage. But let me repeat it and make sure I understand it, and then I want to dig a little deeper into it because I think it's just extremely insightful and important. So what you're saying is that, let me get both parts, those two options. The non-recourse part, the government in many states in America has a law that says the bank can't come after you for extra. So normally, that privilege of being able to walk away from your house, you're saying, I'd have to pay for it. But the government forces forces everyone to pay for it, I think would be the right way to say it.
Well, the only way it can do that is if it provides subsidies to borrowers who can take advantage of that option. So, even if the law said you're not allowed to offer a recourse loan, the interest rate on these non-recourse loans would be higher if the market were working, and in particular, it would be much higher on loans with low down payments. So I think the incentive for people to buy a house with with less than 10% down in a world of non-recourse loans, they would not have the incentive to do that. Banks would be imposing a very high interest rate penalty. So again, you'd face a choice. Gee, if I buy the house now with 5% down, I get a 6.5% interest rate. I can bring that interest rate down to 5.5% if I wait and save up for 10% down. Maybe I'll save up for the 10% down payment. That's what what I think would happen in a market.
But there are states that have recourse loans.
Yes, I think for a while the story was that those states were states where interest rates were slightly lower, but I think the ability to enforce recourse loans has deteriorated.
Yeah, that's still
it's just become the custom in the United States that you can walk away from the house, so I think because of the decline in enforcement of recourse, I think the interest rate differentials have gone away.
Right, the court has got to then let a bank take your house, take your car, take your garnish your wages, and it's got to be willing to enforce that contract. But let's talk about the other part, the prepayment part. What role does government? So in the prepayment part, I could lock in an interest rate and forego my right to refinance, in which case I'd get a lower interest rate. Can I do that now?
I believe not. I'm not sure what the legal status is, but I think it's pretty hard to even include a prepayment penalty in a mortgage. And in any case, during the recent financial crisis, prepayment penalties, consumer groups, took the view that prepayment penalties were anti-consumer, even though they, in some sense, they're pro-consumer in that they allow the consumer to get a lower interest rate than they would otherwise. So I think, I think that's been difficult. Again, let's go back to the Great Depression, which is sort of where the government changes its involvement in the mortgage industry. You have borrowers defaulting on these 5-year balloon mortgages. The typical mortgage is 5 years, no principal amortization. So the entire loan is due in 5 years, and all of a sudden, circumstances have changed, and the borrower has a harder time borrowing, and so we have lots of mortgage defaults.
I mean, the borrower has a harder time paying it back.
Yeah, because they have to pay it back all of a sudden after 5 years or get a new loan. So the government says, no, we don't like that. We'd like amortizing mortgages where people pay off some of the principal gradually. That's safer. And we'd like them to be over 30 years and with fixed interest rates so that the borrower is not facing any interest rate risk. So they set up FHA to offer those kinds of loans, and they create a savings and loan industry under the completely separate regulatory and insurance structure called the Federal Home Loan Bank Board, where I think it might have almost been by law that they couldn't offer adjustable rate mortgages. It's certainly by custom, if not by law, savings and loans, focused on 30-year fixed rate mortgages. And then, of course, they went belly up in the 70s and 80s because they were taking too much interest rate risk.
The savings and loans did.
The savings and loans.
Let's come.
But the government still wants to keep this 30-year fixed rate mortgage as the standard, and so they come up with they expand the role of Fannie Mae and introduce Freddie Mac to keep the 30-year fixed rate mortgage going. The problem is that the taxpayers were taking the tail risk, that is the risk that these options would turn out to be extremely valuable. So the taxpayers, it turned out, were on the hook for the default option becoming valuable, and I think they were also on the hook for the prepayment option becoming valuable, although the interest rate risk is not in this instance what destroyed Freddie and Fannie.
Well, it's only $390 billion and counting, so it's really a bargain. By the way, that number differs from the official government number, which is, I think, $145 billion, and that's because the CBO number, which is the 390, has a different accounting standard. I suspect a slightly more appropriate one than the Treasury and GAO budgeting number. But I'm going to go back to your historical account. We've talked about this before in a previous podcast when I knew a lot less. I know a little bit more now, so I'd like to review it, and I'm sure listeners would be happy to hear it as well. Explain the role that Fannie and Freddie played, and of course still play now through the government who runs them, in making 30-year mortgages more attractive than they otherwise would be, and that has to do with a bank's willingness to hold this 30-year asset, right? That Fannie and Freddie allows them to get them off the books.
Okay, so imagine you're a savings and loan, and you've got mortgages that are going to take 30 years to repay, and you've got these deposits that will be withdrawn at a moment's notice. You can see how fragile that setup is. If the market isn't perfectly smooth and stable, that's really an unsustainable imbalance between the duration of your assets and the duration of your liability.
Explain that. Explain why.
Well, if interest rates go up a little bit, the market value of your mortgages. So let's say you're paying 3% on deposits and you're earning 6% on your mortgages, and now rates go up by 5 percentage points. So you could get 11% on a new mortgage, but you issued 6 mortgages at 6%, so you're not getting that. and now your deposits cost you 8%. And you're now losing money on everything. You're getting 6% on your mortgages, and you're paying 8% for your deposits. And you can't do that for very long without going bankrupt. So that's the fragility of that setup. So what you need is to be able to borrow long as well as to lend long. So maybe not for 30 years, but issue at least 10-year debt to kind of offset to make sure that you don't get caught by an interest rate rise. And Freddie and Fannie had the ability to do that, whereas typical banks and savings and loans, it would cost them much more to borrow. So Freddie and Fannie's ability to borrow, including they had reputations in international capital markets, they were in a much better position to finance these mortgages than were the typical banks and savings.
So what they were essentially doing was, you say, borrowing long. They were issuing bonds or debt where instead of having to pay a depositor back on demand, they had a long, slow, on a bond, say, interest payment, which would match their portfolio of loans that they were collecting money from.
Yeah.
So the question then is, would there be, in the absence, and so that would have worked out pretty well. In fact, there's a passage I love from Joe Stiglitz where he explains how there's market failure in the mortgage market, and that's why you need Fannie and Freddie. And so what he forgot about was the fact that Fannie and Freddie would have their own incentives to push the regulatory envelope, and that's why we're out the $390 billion and counting. But it does raise the possible question, if it's really truly, if you want to call it a market failure, the fact that I don't want to call it.
It's a failure to provide the mortgages that Joe Stiglitz might want to provide.
That he thinks are
it's hard to describe. I mean, the traditional market failure is some, kind of, people, no one owns the fishing rights, so people overfish and produce an outcome that individually makes sense. That is, you get as much, you try to catch as much fish as you can, but collectively destroys the fishing grounds. That's a typical market failure. I think it's really stretching the term market failure to say that there's some market failure in the mortgage market because you don't get the kind of mortgages that Stiglitz wants.
Right, but it does raise the possibility that could a private financial institution emerge without government that would play the role of Fannie and Freddie, that would extend the length of a mortgage beyond what it would be in the absence of such a financial intermediary. So in the absence of Fannie and Freddie, and in the absence of regulation that might, like the non-recourse loans we talked about, we might see 5%, I expect we would see, 5-year loans, some kind of short duration loans, or if there were longer duration loans, they'd have relatively high down payments, and that would be fine. That world would do okay.
I think to get the longer duration, you need to have some way to manage the interest rate risk also.
Right.
So,
that's where you need the.
So either you have to have banks that can develop, the ability to issue long-term bonds to investors and investors willing to invest in those, or something like that. And
an individual bank would struggle to do that, presumably.
Although I don't see why a well-capitalized bank would be in any worse position than Freddie Mac or Fannie Mae, other than that the well-capitalized bank doesn't have this implicit guarantee from the government that if all else fails, the bonds will be paid off by the government.
Well, that means they'd have to charge they'd have to offer a higher rate of interest to attract the long-term loans.
Right.
And it means they'd have to provide some kind of assurance about their capital.
Yeah, they might have to hold more capital than Freddie Mac and Fannie Mae did.
Just a little more, which I think at times were... I think
probably a lot more.
At times they were leveraged 60, 70 to 1. So all that would mean what that would mean, and by all that would mean, I don't mean very little. I mean, the most important thing that would mean is that interest rates would generally be higher.
On 30-year type loans.
And probably
so borrowers would see an incentive to share some of the risk of interest rate movements and to not have such a valuable prepayment option.
And that seems like a good thing. It would be slightly less pleasant to be a buyer of a home, but it'd be more pleasant to be a taxpayer.
Yeah.
So, and it would have a stability to the system that we could stop worrying about it all the time.
Yeah.
So my question is, and this is maybe our punchline, who's benefiting from this current system? Why is it that the political forces are so strong to maintain it? So I want to think about this as a short run and a long run discussion. The short run discussion, right now, the government is running Fannie and Freddie and presumably doing so to make sure that buyers can get access to mortgage financing in a relatively turbulent time. They're very anxious about the price of housing in various markets, and low interest rates, which are very artificially low right now, are helping to keep the price of housing higher than it would otherwise be. So there's a big short-run incentive for the government to continue the subsidy that the system has created in the past. Is there a long-run incentive as well? Who's benefiting?
I can tell a rent-seeking story.
Yeah, please do.
And it really goes back. You can see the beginning of it, perhaps if you read Michael Lewis's first book, Liar's Poker, where he describes what's going on in the 1980s and at some Wall Street firms, and they're looking for profit opportunities, and then you notice that the mortgage debt market in the United States is huge. It's maybe the biggest debt market, and Wall Street isn't really involved in it very much. But there's a potential to be involved in it if you could securitize a lot more mortgages. But securitization only only makes sense if these embedded options are important. You can't. If you had 5-year mortgages, you couldn't carve them up into complex tranches to get any profit. But 30-year mortgages, you can kind of carve up into different securities, and there's a profit to be made in doing that.
Is that because people have different tolerances for risk and taste for risk across those longer?
Right, and people have different habitats, and also, quite frankly, I think Wall Street can fool people pretty easily. I mean, there was the story that came out, I guess, a couple months ago about this Abacus investment where the SEC is accusing Goldman Sachs of misleading investors. But if you read Michael Lewis's book, and this is from 25 years ago, they're in the business of trying to take advantage of their customers, all along. And they...
Not sure I believe that, but...
Oh, I think so. I think that... just Michael Lewis gives some examples of things that he did himself, and he was kind of a neophyte at this, where he was able, the customer isn't really, some customers aren't aware of what prices should be.
Sure,
well, that happens. They don't calculate the risk properly. So a lot of this, so a lot of their ability to create markets is in some sense the ability to take advantage of other people's stupidity. But even aside from that, they're carving up these securities and making a lot of money. They're making money creating the securities, trading in the securities, giving advice to other people on securities. So it was just a huge profit opportunity for Wall Street. Whereas if the mortgage lending stayed at banks, with banks issuing long-term certificates, like 3-year and 5-year certificates of deposit, or other forms of debt, and then funding 5-year mortgages, there's nothing in it for Wall Street. So I would tell a rent-seeking story, and I think if you read Michael Lewis's book, you can see how hard they the Wall Street firms worked the political process in order to establish mortgage securitization, and now we're at the point where many politicians have been sold on the idea that securitization is absolutely necessary, that we cannot have a mortgage market without securitization. And I think that might be true for the 30-year fixed-rate mortgage, but that in turn means that the 30-year fixed-rate mortgage in the end needs to have the tail risk taken by taxpayers. Wall Street has proven that it cannot take the tail risk. It certainly you couldn't take the...
When you say the tail risk, you mean...
I mean the risk of very extreme events. So an extreme drop in house prices.
A big move in interest rates.
Or an extreme move in interest rates. We haven't had an extreme move in interest rates since the 1980s, so I can't say that absolutely Wall Street cannot take the tail risk, but I bet you they cannot. And they certainly could not take the tail risk on the house price side. You had all these firms that had to run into the arms of Uncle Sam when house prices fell. And now they don't want to take that tail risk. What Wall Street wants is for Freddie Mac and Fannie Mae to stay alive, but revert to the model that Freddie Mac had in the 1970s, which was it was a purely government agency. It had no private shareholders, and did not have any mortgage portfolio to speak of. All it did was guarantee against the default risk. So it took care of the default option, that is all the risk involved in the default option, but it did not take care of any of the risk in the prepayment option, and that would give Wall Street the opportunity to carve up mortgages into securities where the prepayment option would be hidden and spread around, and they could earn money again by underwriting securities, by trading securities, and by giving advice on securities.
So if we asked Wall Street as if it were a oracle, we asked Wall Street, well, gee, that seems a little bit good for you and not so good for me. They would, of course, I think, respond and say, well, not good for you as a taxpayer. We made a mistake. It got out of hand. So we've got to make sure it doesn't get out of hand again. So we're going to put some restrictions on. And it's good because it means that home buyers can finance their mortgages at a, quote, low price. It's a little bit misleading, of course, because that low cost of capital for home buyers helps raise the price of houses artificially, correct?
Yeah, sure. No, but the violins that they'll play are the violins for the first-time home buyer, affordable housing, maintaining value of houses, the real estate market. I mean, they create a broad lobby in favor of that.
It's always important to remember in any discussion like this that the alternative to buying a house is renting, which is not homeless, right? Yeah. If you don't own a home, you're not homeless. You are usually a renter.
Right, and as you pointed out earlier, the real comparison may be buying a house with a subsidized mortgage for $200,000 or buying it with an unsubsidized mortgage for $180,000. And that the different people benefit from those different setups, but it varies. It depends a lot on your timing.
Yeah, but there's another aspect of this. John Popola was talking to me about the other day. It's an excellent point, which is that when you increase home ownership artificially, which is what we've labored to do for a very long time in the United States, certainly since the Great Depression, and then with greater zeal starting in the early 1990s through 2005 or so when it exploded, 2006, and then through 2008. One of the things you do is you make it harder for people to move. And it has impacts on the labor market. So when you're unemployed and you think maybe you should move, forget this issue of being underwater and struggling with the issue of whether you should walk away from your house or let it go into foreclosure, whether you should default. The fixed costs of moving in and out of property are very substantial.
Yeah.
And it's interesting to think about where that. I mean, a lot of that is. I don't know what a lot of that is actually. I don't know why it is. It's so expensive to buy and sell a house. A lot of it's is state and local regulation of registering the deed in particular ways, but maybe it's not. I mean, you really don't want to mess that up. It's your largest asset. So the fix turning a house, buying and selling a house, and then buying another one because you have a better opportunity in a different market to work, or because you've had a baby, or because your kids have gone off to college. Those are all very expensive, and we've distorted that choice dramatically by making it so relatively inexpensive to buy a house.
Yeah, and yeah. So it's not clear that home ownership has only benefits and no costs.
Well, let you play your stereo as loud as you like. For most of us, that's really in the early years, that's our main attraction. And you can, nail a lot of things into the wall. It's your house. Live it up. Yeah. And you get a backyard often, which is part of the appeal. We're almost out of time. I want to ask you about a related but somewhat different topic, which is the general interest rate policy of the Fed right now. If you look at the Fed over the last 10 years, it looks something like a roller coaster. We had a period where interest rates plummet, federal funds rate plummets around 2001, and supposedly in fear of a recession and a bigger recession in response to the 9/11 attacks and the tech bubble bursting. And then they stay very low, around the 1%, the federal funds rate, around 1% for a number of years. And then all of a sudden they start rising rapidly. And John Taylor has criticized this, of course, very emphatically. And then Ben Bernanke, in response to the 2008 crisis, brings interest rates down to, I think, what are they, 0.25% right now, the federal funds rate? Extremely low, close to zero. And is that, in your opinion, is that affecting all interest rates? Most people say yes. And if so, what does that do to the allocation of capital in the United States as we jerk this interest rate around?
Well, I have to admit that my personal opinion, and this maybe reflects flaws in my background, but my personal opinion is that the capital markets determine interest rates, and the Fed is very often following. So I'm one of the people who doesn't like to interpret events as being Fed caused.
Well, I used to be in that group. I'm less in that group now. Here's why. Right now, you can't get much return for your money. Why is that? Why is it? Is it because let's take the Fed? Let's look at economic fundamentals. Let's get the Fed out of the discussion. People are very anxious. They're anxious about the future. They're worried on the saving side. People are very anxious to save because they're worried about the future. They're saving more than they used to, but they're not saving an extremely large amount. But they're apprehensive about lending their money out to risky things. On the borrowing side, people are apprehensive about borrowing because they're not sure that the business that they might want to start is going to be successful, and launching it during a time when a lot of people are out of work who might buy your product. But there are a lot of businesses that are humming along, doing okay, who'd like to use some funds to make their business work more effectively. They'd like to use the financial markets to smooth their inflow and outflow of cash. So what's going on fundamentally that makes it so difficult right now to earn any money? And any thoughts on that? Why is the market interest rate so low if it's not the Fed?
I guess that really the demand for borrowed funds on the part of businesses is low. You've got it's not clear where you want to expand, And I think we're at a stage of business cycle where businesses want to see profits before they expand rather than expand in anticipation of profits. That would be my answer.
Well, I think that's true. And I think there's a lot of folks sitting on waiting to see which way government policy is going to go, which way the economy is going to go. It's just surprising to me that it seems to me hard to argue that the low rates that we see right now are not due to an enormous surge of liquidity on the part of the Fed. You want to still hold that view, though?
Yeah, I still hold that view. I think short-term inflation is low, so it's not clear that real interest rates are necessarily a lot lower than usual.
That's a good point. I like that. My guest has been Arnold Kling. Arnold, thanks for being part of EconTalk.
Thanks, Russ.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.